Welcome to today's daily brief. Ever stared at your trading screen and felt like something just isn't adding up? Trust me, you are definitely not alone. Today, we're diving into this explainer to debunk a massive illusion that the financial markets are masterfully projecting right now. We aren't going to waste time on the basics. We are looking straight behind the curtain. So get ready, because what we're going to break down today will completely change how you read the market. So, are you trading on incomplete data? I really want you to think about that for a second before we dive in. We constantly make investment decisions assuming the chart right in front of us is telling the whole truth. But what if I told you that what's on your monitor is literally only half the story? Today, we're going to see why trading based purely on surface-level public information is like trying to finish a giant puzzle when you're missing half the pieces. Here is our roadmap for today. 1. The interest rate illusion. 2. Faking right and going left. 3. The rise of dark pools. 4. Why your charts lie. And 5. Tracking the smart money. Let's get right into it.
All right, section 1, the interest rate illusion. To really understand the current illusion, we have to zoom out and look at the macro environment. Right now, there is immense political pressure to project a perfectly strong economy, especially with the midterms coming up. The administration desperately needs a rising stock market, sustained earnings growth, and zero economic shocks. Everything has to look flawless. But here is where the public narrative violently clashes with reality. Look at this number, 3. Despite this desperate need for a growth-friendly environment, the options market is currently pricing in 3 imminent interest rate hikes. It's a massive contradiction.
If you look at the headlines, the public narrative is screaming about aggressive inflation and inevitable rate hikes. Top officials from the Federal Open Market Committee, or FOMC, are heavily pushing this hawkish tone. Basically, they're setting the stage for a head-on collision between the political desire for stimulus and the rhetorical threats coming from central bankers. Which brings us to section 2, faking right, going left. Have you ever heard of the Maradona theory? Think about the legendary soccer player. He would fake a move to the right, throw the entire defense off balance, and magically create all this space to sprint down the left. Well, in the high-stakes world of politics and economics, this brilliantly illustrates what is happening right now. Key figures are putting on an aggressive, hawkish public posture to appease the central bank, while in reality, they're preparing the ground for a completely dovish pivot. It is a textbook fake-out. Let's look at this objectively. On one side, you have the public stance, a hawkish attitude designed to project toughness and control over inflation. But when we peel back the layers and look at the actual data, we find a much more dovish reality that's quietly being driven by the underlying economic metrics. And here is the irrefutable proof of that hidden reality, 2.38%. This data point is huge. The 5-year inflation expectations are sitting remarkably low, just hovering slightly over 2%. I mean, if the market genuinely believed the whole out-of-control inflation narrative, this number would be skyrocketing. But it isn't. Let's break down exactly why the expectation of massive rate hikes is fundamentally flawed. First, long-term inflation expectations are totally under control at 2.38%. Second, critical inflationary drivers, like oil and gas prices, are actually in a clear short-term downtrend. So the main takeaway here, the aggressive rate hikes that are supposedly looming literally lack justification in the cold, hard data. So how is this whole Maradona feint going to play out? Well, brace yourself for this highly likely timeline. In August, during that low-volume vacation period, we might see a sudden market drop designed to just shake out retail investors. Then, as fall approaches, the true play is revealed, a sudden dovish pivot that sparks a powerful rally. And it all perfectly times out so the midterm elections happen with the stock market sitting pretty at all-time highs. Let's shift gears to section 3, the rise of dark pools. Because you know what? The deception doesn't stop at the Fed. We need to talk about dark pools. If you aren't familiar, these are exclusive private exchanges. It's where major banks and institutions go to trade massive blocks of shares completely anonymously. Why do they do it? To prevent those gigantic trades from moving prices on the public market before they are done buying or selling. Historically, these dark markets were just a tiny sliver of trading activity. But look at this now. Today, volumes are hitting all-time highs. It's estimated that between 30 and 40% of total market volume has been pulled off public exchanges and hidden in these dark pools. That means almost half the market is operating completely out of your sight. So why this sudden flight into the shadows? It's simple, really. Institutions are hiding because retail traders just aren't the weak players they used to be. Armed with AI, powerful algorithms, and incredible access to information, everyday traders are actually catching on to institutional moves. To keep their edge, the smart money has simply decided to turn off the lights. Which perfectly sets up Section 4, Why Your Charts Lie. You are operating on a completely asymmetrical playing field. Out on your public exchange, transparency is total, and the market impact of a trade is immediate. But over in the dark pools, institutions operate with zero transparency, the impact of their trades is delayed, sometimes published days later, and the volume is totally hidden. It's like trying to play chess, but you literally can't see half of your opponent's pieces. This is the absolutely crucial thing you have to internalize. Because 30 to 40% of transaction data is just missing from your screens, your standard technical analysis indicators simply aren't telling you the whole truth anymore. That rock-solid support level on your candlestick chart could crumble in seconds, simply because you couldn't see the massive block of shares an institution was unloading in the dark pool at that exact same price level. Finally, Section 5, Tracking the Smart Money. Okay, so how do we fight back? Here are 2 actionable steps you can take to peek behind the curtain. Step 1, start incorporating data platforms that feature dark pool information using specialized indicators like the DIX, which specifically tracks hidden liquidity. And step 2, which is arguably the most powerful tool you have, learn to read the options market. The options market is the ultimate lie detector. While institutions can hide their stock trades in the dark, they almost always need to hedge the risk of those enormous positions. And the absolute most efficient way to do that is through the options market, which is public and highly trackable. By watching the flow of contracts and volatility, we can piece together exactly what the smart money is actually doing in the dark. So, to wrap up today's brief, I want to leave you with this question. Now that you know about the Maradona feint with interest rates and the fact that nearly half the trading volume is being hidden from you, how will you adapt your strategy tomorrow? Relying on yesterday's rules just isn't a viable option anymore. You have to look past the headlines, watch the derivatives markets, and always stay one step ahead of the illusion. Thanks for joining me for this explainer, and I'll see you on the next one.